The stock market sold off big again on Monday, with the S&P 500 index down an additional 2.64%. This has basically erased all the gains of the past 6 months, and we have now sold off more than 8.5% in less than a month. So we are definitely entering the stock market correction territory. There are countless individual stocks selling off far more than that. For example, Tesla stock today was down over 15% with another 3% after hours. I have many stocks on my watch list and even personal portfolio that have sold off, and I am looking to buy. All of this market selling can create opportunities for the long-term investor. So today I'm going to share my top 5 high-quality stocks to buy right now after their recent sell-off. Many of these are off significantly from their 52-week high. But before I get into that list, let's first break down the investing philosophy for why I'm looking at this market as a buying opportunity. How should the long-term investor be thinking when there are these large stock market corrections and even crashes? Well, at times like these, I like to refer back to the wisdom of some of the greatest investors of all time. So as an example, Warren Buffett, the longtime CEO of Berkshire Hathaway, he learned from his mentor Ben Graham this idea of Mr. Market. I'll let him explain that to you here.
The beauty of stocks is they do sell at silly prices from time to time. I mean, that's how Charlie and I have gotten rich. In the market, you're going to have a partner named Mr. Market. And the beauty of him as your partner is that he's kind of a psychotic drunk. And he will do very weird things over time. And your job is to remember that he's there to serve you and not to advise you. And if you can keep that mental state, that all those thousands of prices that Mr. Market is offering you every day on every major business in the world practically, that he is making lots of mistakes. And he makes them for all kinds of weird reasons. And all you have to do is occasionally oblige him when he offers to either buy or sell from you at the same price on any given day, any given security.
The market is here to serve you, not to advise you. So what that means when we look at our stock portfolio, you shouldn't see a big stock market sell-off and a lower price as something to scare you out of that holding. You don't let the market tell you what to think about the company. That is true on the downside and on the greediest upside as well. Tesla, for example, may be the ultimate example of a Mr. Market stock. The volatility is insane, both in the upside, like for example, this price this December was absolutely ridiculous, but so has some of their historical lows. So when the market lows, don't let the market reaction scare you out of your holding, because then you sell and lock in your losses. But in the highs, don't let the market exuberance tell you that's a signal to buy at those prices. If you were buying Tesla stock at these highs, that was also a mistake. And while we're on this topic of investing psychology, another important thing to focus on is that a stock price is not just something that wiggles up and down. It's an ownership stake in a real business. So you need to look to the business to inform your opinions on the stock, not the other way around. This is another important Warren Buffett principle. He explains that in the following clip.
The key to Graham's approach to investing is not thinking of stocks as stocks or part of a stock market. Stocks are part of a business. People in this room own a piece of a business. If the business does well, they're going to do all right as long as they don't pay way too much to join into that business. The stock market is there to serve you and not to instruct you. And that's a key to owning a good business.
So in this current stock market correction, there are a lot of things that I would consider to be high quality businesses that are now trading at a discounted price relative to their highs. So for example, I just set this stock screener to see the percentage change from the 52-week high. Microsoft's down 18.22%, Nvidia's down 28.4%, Alphabet's down 19.5%, Amazon's down 19.63%, Meta is down 18.83%, Broadcom's down 26%, Tesla's down 53%. I mean, we could go on and on. United Health Group, 22%, Oracle, 22%, Costco, 13%, Netflix, 18%, Salesforce, 25%. So although it's not fun seeing your portfolio in the red and the market value coming down, you have to put on your long-term investor hat and look for opportunities. I know that's what I'm doing. There are many stocks I have wanted to buy, but haven't been able to because I thought the prices were too high. And during this recent stock market correction, I've been buying more than I have in much of the past 6 months. So as you do your fundamental research on long-term investments, I recommend you adopt this mindset. As always, you should do your own research and trust your own investing judgment. But today, I'm going to share 5 stocks I view as good buys in this market sell-off. And the common thread here is I view all of these as high-quality businesses. Personally, during market corrections and sell-offs, I like to pivot towards quality as those companies are not often on sale. So with that said, let's roll the intro and jump into the analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using my stock analysis tool over on dividenddata.com. This has everything you need to do high-quality fundamental analysis on stocks as a long-term investor. Plus, you can ask questions directly to our AI analyst, which has a built-in stock screener to help you find companies. And one simple prompt I looked for today was companies down from their 52-week high. And some of these are companies that I am buying and will be on my list. By the way, if you want to become a member of dividenddata.com and get access to all the tools I'm showing today, we are currently doing a special 50% off sale on the annual plan that will only be available for a limited time, and it's the best price we ever offer. You can try it out at no risk. There's a 30-day money-back guarantee. And if the tool helps you identify just one slightly better stock, then it more than pays for itself. So with stock number 1, let's get controversial. We'll pick Tesla, ticker symbol TSLA. Now, to be fair, this is a growth stock and is not a dividend-paying company. As you know, this channel is named Dividend Data, and we typically focus on dividend growth stocks. Every month, I give you an update on my dividend growth stock portfolio, and this is my dominant long-term investing strategy. However, I have 3 total accounts, and in the others, I am more open to growth stocks. But really, I just think about these as businesses and investment opportunities. And some of you who have followed the channel for a long time know that Tesla is one of my top positions. However, that has not looked good for the on-paper value of my account over the past month. Tesla stock is down 36.6% in that time, and it's down 53.71% from its all-time high. However, you might notice I am still up $25,000 or 128%. And that's because Tesla is one of the most volatile stocks in the stock market, and in my opinion, is probably the worst case of the Mr. Market theory. So there are times of great exuberance where I do not buy the stock or even think about it, but then also huge swings to the downside where basically that's when I nab and increase my position. This has worked pretty well in the past. I increased significantly in January 2023 after that big sell-off. I got it again in like April or May 2024. And after that post-election boom in Tesla stock, I thought I wouldn't be buying it again for many, many years. However, this thing is dropping like a rock and is expected to likely continue keep dropping in the coming weeks. And as we get to the low $200, high $100 range, I might actually add to Tesla stock again. Now you might say, Zach, but their earnings per share have fallen off. And I would say you're right. In terms of Tesla's current earning potential, the stock is still pretty overvalued. But the only reason you're investing in Tesla stock is if you think they can accomplish their future technical milestones and new product launches. So there is a business risk in that equation. And later this year, you have things like the launch of the robotaxi service, meaning self-driving cars similar to Waymo. This robotaxi service is expected to launch first in Austin, Texas, this June 2025. And I've analyzed and followed this company for a long time. And in my personal analysis, I know people have other opinions. I think they will quickly scale to be the dominant player in that space. They also have other things going on, like the launch of lower priced vehicles, and many years down the road, the humanoid robot, Optimus, and all of that. And let's not forget their entire energy storage business, which is growing very fast. But the key story here with Tesla is this future growth estimates. As you can see, these are the consensus Wall Street analyst estimates. They are expecting future earnings growth to ramp up significantly in the coming years. As you can see, they're expecting 18% growth this year, 32% growth in the year following, 29% growth the year after that, 37% growth, and then 47% growth. So the best growth for Tesla is in the years ahead. If they hit those estimates, they're expecting $10.15 earning per share in 2029 with a 21.8 P/E ratio based on today's stock price. So when you think about it like that, the valuation really does not seem that nuts. The consensus price target on Wall Street is $269.80. That implies 21.45% upside from here. However, I like to be even more conservative when I buy Tesla because there is a larger risk, both in business risk and in stock price volatility. So in my personal portfolio, I may start adding to this in the low 200s, high 100s. And then for stock number 2, I'm going to give a little bit of a treat for my dividend growth investors. And that will be a company some of you have maybe not heard of, but should have on your watch list at a minimum. I personally need to do a bigger deep dive into the company, but they are selling off a lot and have great financials. That is Comfort Systems USA, ticker symbol FIX or FIX. This company just dropped another 3.39%, and they are now down 26.55% from their 50-day price average. The stock is down 32.6% over the past month. However, if we analyze the company over a long-term horizon, they are crushing it. As you can see, their stock price has boomed even with this recent sell-off. So let's move it to 5 years so you can see a little closer. Over just the past 5 years, earnings per share has increased rapidly. I'm talking an increase from $1 per share a quarter to $4, and the stock price has boomed in that time. But now we are starting to see a sell-off from those gains, and the current valuation is compelling as well. We're now at about a 21 P/E ratio based on the trailing 12 months and a 0.51% dividend yield. Now, yes, I know this is a low yield, but let's jump over to the dividend data so you can see the growth rate. The growth of fixed stock is insane. Look at this. They are doing multiple double-digit increases a year. The 5-year compound annual growth rate of the fixed dividend is 30.67%. And this is while their payout ratio is incredibly low. So this dividend is basically nothing in terms of their overall earning capacity. The current free cash flow payout ratio is 5.7%. The current net income payout ratio is 8%. And this is sustainably in these low ranges, even with the dividend increases. Revenue per share has absolutely boomed. Over the past 5 years, revenue per share is growing at a 22% CAGR. Free cash flow has exploded. The 5-year CAGR is 47.2%. This recent fiscal year, they had $20.68 of free cash flow per share. That means at today's stock price, the company is trading at 15 times last year's free cash flow, while it is still growing. The balance sheet is strong. They have $549 million in cash and short-term equivalents. They have very low debt. They have negative $487 million of net debt. And again, last year they generated $730 million of annual free cash flow. So this is a company I recently added to my personal watch list, and I'm probably going to do a stock review and may add it to my portfolio soon. Over the past 5 years, even with this current market sell-off, the company has a total return of 851%. Since going public in 1997, the total return is 2,300%. I asked my AI analyst to summarize the latest earnings call, and the company seems to be poised for continued growth from here. They have a record backlog of $6 billion, with that demand coming from various sectors, including technology, industrial, and institutional markets. They are expecting strong results for 2025 with, quote, record-breaking based backlog, healthy pipelines, persistent demand in advanced technology, onshoring, and especially our unmatched workforce. They also re-emphasize that they're committed to increasing their quarterly dividend, reflecting strong cash flow and a commitment to reward our shareholders. So this is an interesting one. For stock number 3, I have Meta Platforms, ticker symbol META. This company sold off 4.42% today. They are down 16.64% over the past month. This makes the company down 18.83% from their 52-week high. And again, I said during corrections and sell-offs, I like to pivot towards focusing on quality. And Meta Platforms is an extremely high-quality business. So yes, in the grand scheme of things, they haven't sold off that much. But you have to keep in mind, this company is rapidly growing their earnings. Revenue per share is growing at a 21% 5-year compound annual growth rate. Free cash flow per share is growing at a 23.48% compound annual growth rate. They have a strong cash position, $77.8 billion of cash and short-term investments, negative $28 billion of net debt. And Meta, I'm calling it now, is a dividend growth stock of the future. They just started paying a dividend last year, and they just did their first dividend increase. Now, this was a small increase. It was only 5%, but the capacity to pay dividends and pay an increasing dividend is very high in the future. The current free cash flow payout ratio is 9.38%. Wall Street analysts are projecting double-digit earnings per share growth for each of the coming 5 years. That means based on today's stock price, the 2029 P/E ratio would be 14.2. Another thing I like about Meta is just how kind of locked in they are. They're in a very dominant position with two of the largest social media platforms being Facebook and Instagram. They have one of the best digital advertising businesses. They are a leader in artificial intelligence. That helps with internally improving their own advertising business and getting higher return on investment for their customers, meaning more ad spend. But it also helps them just stay on the cutting edge and be a leader in future technological waves. And say what you want about Mark Zuckerberg. I know a lot of you have many opinions probably about him. I tend to like founder-led companies, and I like that Mark Zuckerberg is still actually pretty young. He just turned 40, so he has a long-term horizon still, which I like. I have not bought Meta Platforms yet, but I am considering adding this to my dividend growth stock portfolio. However, a company I have been buying a lot and adding to my dividend growth stock portfolio is another big tech giant that is a new dividend payer. That is Alphabet, ticker symbol GOOGL, Google. And similar to Meta, these are digital advertising powerhouses. However, Google's is much more weighted to search compared to Meta's being social media. Google also owns YouTube, which is the largest video streaming platform. Alphabet stock just dropped another 4.4%. That's over 10% this month. And if we go back to my initial stock screener I did, they are 19.5% down from their 52-week high. I just made a full stock review video on Alphabet, so you should definitely go check that out if you want to learn more about the company. I personally think that the narrative about search being disrupted and being a declining asset for the company is not true. But I'll give you a brief overview. They're still a fast-growing company. Their free cash flow per share is growing at 21.19% CAGR. And that is despite massive increases in capital expenditures as they increase their AI data center build out. Alphabet has one of the best balance sheets in the world. They have been a money printing machine for decades now, and they are finally choosing to deploy some of that capital internally with their AI investments. They are still in a very strong position. They have $70 billion of negative net debt, and they've started to return capital to shareholders with dividends and share repurchases. So I personally just bought even more Alphabet stock today on top of what I've been buying in the past week. Here you can see my position. It's now my number 5 stock in my dividend growth stock portfolio. That's 6.21%, and I wouldn't mind if it climbs up there eventually to be up there. And I wouldn't mind at all if it continues climbing up to be a bigger part of the portfolio. And then finally, I have Microsoft, ticker symbol MSFT. That is another stock in my personal dividend growth portfolio. It is one of my core positions, the number 2 stock. Microsoft has sold off 3.34% today. They are down 7.78% over the past month. But what's interesting is they're actually down 6% over the past year. So after surging a lot coming out of fall 2022, they've been pretty stagnant in terms of stock price. But I'll give you a little bit of a spoiler. I think the company's fundamentals continue to improve in that time. The stock is down 18.22% from their 52-week high. So I think this is a pretty interesting time to buy the software giant Microsoft. I've been dollar cost averaging into my position, which I'm happy about because I have not bought it at all coming out of that 2022 period. This is one of the most reliable cash generating businesses in the stock market with a continued path to future earnings growth. As you can see, analysts are projecting double-digit growth in earnings per share in the coming years. They are one of the leading players in AI. They have multiple growth drivers going on. I'll probably do a full updated stock review video on Microsoft again in the future. Revenue per share is growing at 15% 5-year compound annual growth rate. Free cash flow per share is growing at 14.86% 5-year CAGR. Again, along with a lot of big tech, Microsoft has a fantastic balance sheet. You can see over $300 billion of shareholder equity. They have $71.5 billion of cash and short-term investments, and that's after making that massive Activision Blizzard acquisition and after they've been rapidly increasing their capital expenditures. So spending has gone up at Microsoft, and they're still in a great spot. And they're starting to build up their net debt towards more negative again. That Activision Blizzard acquisition took up a bunch of their cash, but they're building up that cash cushion again. This is a highly profitable company with a long history of returning capital to shareholders via dividends and share repurchases. The Microsoft dividend is growing at 10% 10-year compound annual growth rate. They increase it 10% every single year. Very reliable. It's a sustainable payout with a 29% free cash flow payout ratio and 24% net income payout ratio. So this is a company I feel very comfortable with having as a long-term position in my dividend growth portfolio. So in market sell-offs and corrections like these, I like to dollar cost average in or build large positions in my high quality players. And if you want to hear more about some of my recent buys being Microsoft, Alphabet, or even Salesforce, go watch my latest portfolio update video. I go in depth more on each of those three. And again, I also just did a full Google stock review video. And if you want to use any of the tools I showed today, whether it's my stock analysis, AI analyst, or my portfolio tracker, all of that's available on dividenddata.com. I made this to be a great research platform for long-term investors. That includes dividend growth investors like me. Right now is a great time to join because we have a 50% off the annual membership sale. You can lock in that discount price for life. There's a 30-day money-back guarantee, so no risk in trying it out. Just click the link below in the description and pin comment. That way you can get direct access to the sale. If not, you can try using the promo code MARCH at checkout. That's MARCH. With that said, thanks for watching, and I'll see you in the next video.